Squawk on the Street. Disney beat on the top and bottom lines. Did see mixed signals in streaming. Overall, direct-to-consumer business did report a profit, but they're guiding towards losing some subs Q1 to Q2. Joining us now from Post 9 is Loop Capital analyst Alan Gould. Has a buy rating. Price target's 125. So what did you think of the quarter, Alan?
Hi, David. I thought it was a pretty good quarter. They did beat on the bottom line. There was a lot of the beat was on the cost side. Revenue was about where we were expecting. But if you look, there's sort of four main things. DTC sub growth was higher than the street was looking for, and they reaffirmed the $1 billion target for the year.
In terms of profitability.
In terms of profitability. We knew that there was going to be churn after the price increase. Didn't know it was going to extend into the second fiscal quarter. In terms of the growth in the DTC business is more than outweighing declines in the linear business. DTC was up about $400 million. Linear was down about $100 million. Parks, they said it beat their expectations. I mean, there's a lot of concerns about Parks because Parks really is the engine. That's the core earnings at the company right now. So Parks did better than expected. They reaffirmed their 6 to 8% guide for the year. I wish they talked about, we're running ahead, our expectations are higher, but did not change or upgrade any of the estimates.
Is that why the stock is not, is down a little over 1%?
I think so. I think if we would have seen any increases in guidance, the stock would be up. The quarter was certainly fine, but there was a little bit of caution and hedging. And given the macro environment, I guess it's not surprising. Rarely do companies raise estimates in the first quarter.
Yeah, I mean, they are talking about that modest decline in Disney Plus subscribers compared to the first quarter for the outlook as well.
Right. And the ARPU was a little less than I was looking for at Disney Plus. So again, it was the cost side. Disney Plus costs, programming costs were down about $115 million year over year. Now, last year you did have a full quarter of Hotstar, including soccer, including cricket. This year you only had a half quarter of Hotstar.
What's the thesis on Disney? Like, how does it all tie together?
Sure.
For the narrative. And do you think Bob Iger has successfully done that? Because what we just ran through were like a lot of separate businesses.
Right. I think the thesis on Disney is it's one of the great brand companies out there. And they've always been able to move their brands to be in the most valuable area, whether it was moving to parks, home video years ago. Now they're moving it to streaming. And the Disney brand is what's key. That's what Iger did. He bought Pixar. He bought Lucas. He bought brands. So the key here is this is one of the great brand companies. The stock traditionally has traded at a nice premium to the market. Not surprisingly, it's been trading at a discount to the market the last few years with the traditional media companies as they're making the transition from linear to digital. Disney seems to be on the right track. Iger seems to have taken it on the right track. Didn't mention the studio at all, but studio's turning around.
Moana 2 was a hit.
Yeah, they had some hits, right?
And Moana 2, if you think about it, a couple of years ago, that was supposed to be a direct-to-consumer video. It was supposed to just go to Disney Plus. And Iger looked at it and saw Moana the original, was the most streamed movie on streaming. He said, why are we putting the sequel to streaming? Let's put it into the theaters. And the movie's done over $1 billion at the theaters.
Because parents just want to get their kids out of the house. It was not even close to as good as Moana 1. I have to say.
Overall, though, Alan, I've made this point a number of times. Netflix quarter, in terms of additional subscribers, was just
a blowout.
Yeah, and nobody's come close. I mean, the Peacock numbers obviously far smaller. No additions here, no real additions. Can anybody truly compete with Netflix when it comes to the streaming war?
I mean, Netflix has clearly won the streaming wars. It's a debate who's going to be number two, and it may be a distant number two.
You think Disney can successfully be number two?
I think number two is probably Disney or Amazon, depending how much Amazon wants to put into it. And we don't know how the rest of the world's going to turn out. It's not going to be separate. Peacock, Paramount Plus, Max. Yeah. I mean, there's going to be some combination of the others. There has to be.
And finally, he did have some nice things to say about linear networks, which we paid close attention to on the call.
I'm sure you do.
They're not a burden at all. In fact, they're actually an asset.
Wasn't that a reversal from what he told you?
Yes, it was.
Interview?
A year and a half ago. But yes, he seems to be getting a little more constructive on them. You buy it?
Not really. I mean, I think he also said we're investing to the degree necessary to grow our streaming business, which is where the future is. So I think they're managing the decline by spending less money on content and marketing on the linear businesses to manage the decline and the transition to digital.
Right. Well, yeah, it was down 11% operating income.
Yeah.
But you're going to put a buy on the big spinoff from Comcast, right? For sure.
Especially CNBC. That is the golden jewel.
Alan, you can come back. Alan Gould from Loop. Thank you.